Well, Larry, it's that time of year again where you, for 1 week, will be 3 years older than me. So happy birthday to you.
Did you say in 1 week? It is today, actually.
No, today is the day that you become 3 years older than me, and then
Oh,
next
in a week's time,
next
you'll catch up.
Sunday I will become. It'll be 2 years again. So yeah. So
So
happy
I'm entering my 80th year, and you're still a young man.
yeah, your 80th year. That's good. I like that. Which means
Yeah.
the way he's 79, in case you're not catching up. Okay. Yeah, I'm still a young man. There you go. All right. Well, Larry, we as usual come together this Employment Saturday because Cathie Wood calls it Employment Friday. She does a video, and we've been doing this for, gosh, I think a year now, where we take a look at what Cathie says and try to add whatever little bits of information we can to it that might make it more interesting or more. Because Cathie, let's face it, come on, can we be honest? Cathie's a little dry.
I don't think so. I think Kathy, for me, she is a lot more informative than we are. Um, she, you know,
I didn't say informative. I just said she's a little dry.
I don't know about it. I mean, we certainly add our perspectives. I don't hold them in as much esteem as I hold her perspective, to be honest. But we each have our points of view, and I must say I'm very impressed with yours. You seem to hit the target a lot. Um,
She has
and
taught me. She has. I've learned from her. I've learned
yeah,
so much.
yeah.
Holy mackerel!
There's a lot to learn from her. And I've prepared slides, which is really a summary of what she said. I've tried to get the meat of it. And I've used Grok, by the way, very much more successfully than in the past. I've used Perplexity, and before that, OpenAI, and then I switched back to OpenAI because I get frustrated with Perplexity, and then I get frustrated with OpenAI. But today, for the first time, I used Grok to do the summary of the transcription. Firstly, to clean the transcription, and secondly, to do a summary, and it was amazing. First time out was perfect. With Grok and Perplexity, there were 3 or 4 or 5 attempts to get it right, and even then,
With open AI and Perplexity for
with OpenAI and Perplexity, sorry. So I'm very impressed with Grok, very impressed with Grok, and we'll come back to that at the end of the
yes, yes.
conversation.
I
Yeah.
would I would also start out introduction wise that Cathie was very optimistic. Uh,
Yes.
pretty interesting that in this, I would call it trough that I think we are in or entering, that she was even more optimistic than I am about what it looks like 6 months from now. So I thought that was kind of the overarching her overarching attitude for the entire program was optimism.
Yeah, I'm not even sure it's 6 months or a year. I don't know. My own sense is it's going to take a year to get there. That would be my view. And sometimes these things take longer. Economic trends always take longer than one imagines. That's been my experience anyway. Um, so, yeah, she is very optimistic about the future, but that's not new. Kathy's been optimistic about the future consistently. And, you know, these mega trends don't roll out in obvious waves. Many times the wave is under the surface and you only become aware of it that the level of the water has been rising quite dramatically after the fact. And I remember quite clearly in the Clinton years, in about maybe the third year of his first term, I was at a major client, and there was another consultant there. And she said to me, the economy is so bad right now. I don't know how we get out of it. And I looked at it and I said, do you realize we're in the middle of the most explosive growth we've seen since Reagan? She said, what? I said, yeah, the economy's turned. She said, no way. And that just illustrated for me, and it's always remained in my mind, how one doesn't realize just how incredibly strongly the economic tides have to turn before one realizes it, and before it affects, before all the boats rise.
Right. Right.
So I think that if you're looking for it next week or next month or next quarter or even the next half of the year, don't be disappointed if you're not seeing it yet. Anyway, that's just my view.
Right. All right. Well, let's get into the slides. Cathie, as usual, has a set of slides. I think you'll show us that are kind of ongoing, but I'll let you run it. Okay. I'll just turn it over to you.
Well, actually, this is a slide that maybe we can share because this is Cathie's introduction. And, she starts by saying that the Fed's GDP now indicator, which the Fed publishes, shows in real GDP growth in Q1. And this is a big shocker, really, because, we've seen quite a steady growth at about the 2% mark, 3% mark. And for it to turn from 3% down to a 3% decline in one quarter is a real shock. The Fed's GDP now indicator, I think, is swings a little bit too widely on both sides too early. But nonetheless, I mean, we have really been in a rolling recession since 2022 because, the Fed rate hikes. And we've talked about this so often, you and I together, that, the recession is not felt evenly across the economy. And so you get, the Magnificent Seven doing gangbusters, you get a few of the tech firms doing really well, but even the mid-size, public companies are kind of rolling along in, reasonable fashion. But the bulk of the economy, that is to say, mid to small businesses and, the individuals are really, really feeling the crunch, and they've really experienced the recession.
And I think this will become clear in some of the slides, but I think as an overview, this 3% decline, which is an annualized number, it's not
Yeah.
saying it's going to go down 3% in the first quarter. It's an
Right.
annualized number, is heavily influenced by the imports, which were front running the tariffs. So
Yeah.
that import number really, really hits big in this first quarter. And the second thing is the consumer confidence numbers, which were way down. Uh,
Yeah.
in
I'll expand a little bit
Okay.
on how
Okay.
imports impact the GDP, and not necessarily accurately.
Mhm.
Um, it's a technical issue. So I think that is influencing it in a big way. Yeah. So equity markets may soon focus on future productivity-driven GDP growth. This is, of course, the innovation thesis that Cathie has. And then she says, despite initial setbacks, tax cuts and deregulation could boost small businesses and innovation. And of course, it's small businesses that are hurting. And there are, millions of those. And small businesses really denote not only incorporated companies, but individual, personal, people who run, day-to-day personal businesses. So we start with fiscal policy, and here we always start with this budget deficit. No, we don't always actually. This is a relatively new slide. Budget deficit or surplus percentage of nominal GDP. And you'll see that this deficit has been running fairly consistently, except for that magnificent period in the 1980s where
1990s,
Gingrich,
90s, 90s.
sorry, 1990s, where Newt Gingrich and Bill Clinton agreed on a budget. Must have been the first time in 20 years that we had, more than 20 years, maybe 30 years, that we had the Democrats and the Republicans come together. And after that, it's been downhill all the way into deficit country, of course, exacerbated by the terrible response that we had, or the terrible government response we had to the epidemic, which was really, we've decided after the fact, was unnecessary. Although given at the time, there was, little knowledge about what really was going on.
And I would say, Larry, as I listen to, all of these pundits and also the phenomenal leadership in the cabinet right now, talking about what's going on with our economy and what the plan is. This is the chart. This is the focus. This is what Scott Bessent, this is what, just go down the list. They're all focused on the 7% deficit, needing to get it back to 3%. And she puts a little X there, so almost impossible to see, at 3%, and says,
My cursor's at that point now.
this is what we need to get back to, and this is what DOGE is doing. This is what the entire administration is focused on, is getting this back to 3%.
Let's explain the reason why 3 is such a magic number. Because at the 3% deficit mark, you can actually have a growth that offsets that deficit, so that over the long term, you're not going to worsen that deficit, and you're not going to run into a bankruptcy kind of situation. And of course, what happens is that if you worsen the deficit from year to year, what happens is that you get into a spiral that you can't get out of. And we're in the midst of that spiral. We're at the beginning, or even beyond the beginning of that spiral, because we've been below this mark now for well over 3 years.
Right.
And before that, we were below it for a couple of years. And so this spiral, and it's not getting better right now, so that if we continue in this path, we will actually be in an Argentina-like situation. So this is the magic number at which we believe the country can continue, and as long as we have innovation and growth, we can overcome. So that's why this tremendous focus on that mark. And you're right, absolutely right. That is the principal focus of the Trump administration at this point. And for all my disagreements with some of the policies of the Trump administration, this is the one that I'm fully aligned with them on.
Okay.
So now we move to the sources of federal revenue since 1790. This chart really started appearing last month, and Cathie shows it for a very good reason. It shows that from 1790, since the founding of the country, our revenues, all the way until 1913, principally came from what? Tariffs.
Yep.
And since 1913, we've had an income tax and very little income from tariffs, but the bulk of our income from income tax. And this is percentage share federal revenues, not absolute revenues. If it were absolute revenues, these numbers would be in the 10%
Right.
of the economy, and these numbers are in the 30% plus of the economy. So it would be a very different graph entirely. And by the way, that's one of the problems. It's unclear at all what percentage of revenues we could ever derive from tariffs, given the level of expenditure of the government today. And so, but it could be argued that some of those revenues can come from sales tax, or should come from sales tax. Our tax, income tax is a really bad idea. at least income tax at anything like the levels of percentage of government revenues that we earn today is a really bad idea. And so I'm not clear that this is corporate and individual income taxes, including a state's income.
Oh,
So I'd really like to get an understanding from Cathie about that. Maybe I'll ask her about that.
it says federal receipts.
Federal
Revenues,
see that federal
yep,
receipts.
yep.
Yeah, so if you add states
Yeah.
taxes to that, I mean, it'd be interesting to know what percentage of state taxes came from indirect taxes and what came from direct taxes. But there's no doubt this whole concept of direct taxation has to be revisited because the percentage of direct taxes now being paid by the populace is just incredibly high. And yeah, I mean, the tax rate at the top is compressed a little bit since the height of the 50s or the 60s, 50s, I guess. But nonetheless, the middle class is being taxed extremely heavily in relation to history.
And Larry, let me also say about that 50s and 60s things, because people get really confused by that. And the Democrats use it against the Republicans all the time. In the 50s and 60s, actually 70s also, before the Reagan changes, the actual amount that high income earners were paying was still about the same as it is now.
Yeah.
We had tremendous write-offs. We had write-offs for everything. So
Yeah.
people that were making $1 million a year, they could write off, 800,000 of it.
Yeah.
And then what Reagan did was say, look, let's get rid of these write-offs. Let's simplify. Let's get rid of the write-offs. We'll lower the overall rate, but we'll eliminate all these write-offs. And so there's a lot of rules, interesting rules with regard to what high income earners will allow, so to speak, what they will pay before they cheat or steal or go offshore or move or do something in order to not pay more. So there's kind of a max.
Yeah. Yeah. I used to visit Great Britain and I was in South Africa that really followed the UK in their tax regime. So at my age, I lived through the super tax where 98% of your income was taxed. And it was a terrible environment. And that's really what cost Britain its wealth and its vigor in the post-war years. The post-war years were a disaster for Great Britain.
Yeah.
And Winston Churchill foretold that. Winston Churchill definitely foretold that. But, the British felt that they wanted to try socialism, and they did. And it was a catastrophe. They thought they could tax the wealthy to, middle class level, and they could bring the poor up to the middle class level and level everything out. But the catastrophe was, I remember days where there was no power for 3 days a week.
Mm.
No power, zero power for
Zero.
3 days a week.
Yeah.
The country was on the verge of bankrupt. Well, it was at bankrupt and it was on the verge of revolution.
Right.
Anyway, so the next slide, now we move into monetary policy. And we start by always looking at the money supply versus the CPI, that's the inflation rate. And here we have, if you look at the slide, you'll see the green is the CPI, that's the cost consumer price index, and then an M2, that is the money supply. Because we've known for a long time, Milton Friedman taught us that the money supply is really responsible for inflation. And so we watch the money supply like a hawk. We know that when the money supply rises, that within a year or 2 or 3 years, inflation is going to rise. And there's been a frightening rise in the money supply. And this is, frightening rise in the money supply here. And the inflation rate will increase accordingly in 3 years' time.
Actually, you got that one backwards, Larry.
I always get it backwards. I always get it backwards.
The purple is heading ahead.
Yeah.
Is it an 18-month lag? I forget.
Yeah, it's actually a 2.5-year league, a 30-month league, I think.
Oh, it's 30. Okay. So it's showing.
No, it's leading by 18 months here, but I think it's close to a 30-month myself.
Okay, but on the chart, it's an 18-month lead.
18-month lead, yeah.
So it's showing how the money supply going up 18 months later, roughly speaking, it'll impact inflation. Now, in this particular case, though, we have a very dramatic situation where we had this huge increase in the money supply and then a huge decrease in the money supply compared to this kind of flatlining, in the previous years. And so we're kind of catching back up. And one would expect it to kind of flatten out now. And that, of course, is what is going to happen.
Well, the money supply is only beginning to flatten out. But I will tell you that there's something missing in this slide. I tell you this every month, and that's velocity of money.
Right. And that's the next slide, right?
Yeah. So this first time that we've had velocity included, maybe the second time we've had velocity included. But one of the reasons that even as the money supply has risen dramatically, that there hasn't been inflation, it's because velocity dropped dramatically. And velocity has been low for years. This is where velocity always was, except for this terrible period, in after the 1990s where we allowed it to rise. But it's always been roughly at this level here. And this kind of change in the money supply has terrible velocity of money. That is the rate at which money turns over in the economy has it has a direct impact also with a lag. And so we're seeing that money supply is finally, it's not back to its norm yet. This is the norm. It's not even close back to the norm. So we've been able to increase the money supply quite dramatically without a concomitant increase in the inflation rate. But it is up. It is up since the pandemic, and now money supply really does count a lot more than it counted a year, 2 years, or 3 years ago. And so that lag, we're only beginning to catch up to it now. And so I think it may be a little bit tougher than we think it's going to be to actually beat this inflation.
And Larry, once again, I just can't help but bring demographics into this. She touched on it for a second, but I didn't think deep enough into it. You're going to have less velocity of money when you have an older population. Older populations are not, redecorating their houses frequently. They're not buying stuff anymore. They're investing the money, putting it away, and it's just sitting in treasuries and sitting in, solid, institutional kinds of, in other words, things like
savings accounts.
Yeah, savings account, money market, stuff that's very flat. They just put it in there and they forget about it. Nobody's moving. People are not changing their homes. They already weren't. We had gone from moving once every 5 years to moving once every 12 years in a generation. And now it got worse because nobody's moving out because they're stuck. And we'll talk about that, on another slide as well.
Yeah, that's why it's so hard to talk about these historical norms and trying to relate them to current day because there's so many variables.
Right.
You touched on an extremely important variable. But, it would be good to try and combine these two slides in a meaningful way.
Yeah.
And the problem is the combination isn't necessarily, definitive because the delay between the actual inflation rate and the money supply rate is compounded by this, and is also compounded by the difference in, as you pointed out, aging population and so on and so forth. So there's a lot of factors that we have to take into account. And now we turn to market signals to see what's actually happening in the real economy. We start by something which is not real at all, and that is consumer sentiment index that the University of Michigan measures. We had a peak at post election. It's beginning to fade. I suspect it's fading almost by the day right now. There's a lot of, there's a lot of pent-up excitement, and that excitement is deflating fairly rapidly now as the reality of the difficulties face and the opposition occurs, and, the press, which is very, very negative, keeps the negative drumbeat on. So uncertainty is at a near record high, says Cathie, amid these administration changes. And Trump's negotiating style may intentionally create chaos.
It
Whether
does.
it's intentional or not, it is definitely creating chaos
It's intentional.
at the economic level and at the fiscal level.
Yes, and international level. Yes.
Yeah. Rising egg and oil prices now easing, upset consumers, and sentiment reflects broader transition-related fears. So, yeah, we're living through a very, very tough period in terms of the day-to-day and the new administration. I think economically, I feel very positive about where the administration is going. I think that's the strongest part of the new administration is their economic policy. I'm having a hard time with their foreign policy. I think that that's an issue. But as far as their fiscal policy is concerned, and as far as their policy relating to education and quite a lot of other internal issues, I'm very strongly aligned with them. But financially, I think economically, they really have a grip on this. And the grip is on this terrible, terrible deficit that we've generated and the debt that we have. And they're taking the only actions that are reasonable in the circumstances. And some of that's informing their foreign policy.
Sure.
They're pulling back from this very aggressive, global policy that we've had for the last 20, 30, 40 years. And they're saying we need to cut our jib here, and according to the winds as they blow. So,
Yeah, so the good news is for those who are not just reading headlines, the good news is the economic policy of the Trump administration is extremely clear. We know
yes,
exactly where they're going. It's transparent. It is not changing. It is promises that were made and promises now being kept. This is fantastic for somebody that's paying any kind of deep attention to what's going on. But the average citizen out there doesn't have time or doesn't have the interest to go beyond the headlines. And the headlines are, oh my gosh, the tariffs, oh my gosh, the layoffs, oh my God, and so the headlines are scaring the folks even more than I think Trump was hoping to create chaos, the headlines. And when you go deeper into the consumer sentiment and the consumer confidence index and the small business index as well, all of them are saying it's the tariffs that's got them scared. And the tariffs
right.
and the tariffs shouldn't scare anybody. It's not going to hurt the economy.
Well, Randy, that's easy to say on a macro level, but
Right,
when you're a small business person
right,
importing,
right.
say, water bottles,
Say,
yeah, you're very scared. So consumer index is here, and we need it to be here.
yep,
That's really the big challenge. And look, this is the same challenge that Trump faced in his first term. It's the same challenge Reagan faced. It's the same challenge Clinton faced.
right.
But we're talking about, three administrations that were really very successful. Well, Trump was successful until the pandemic, and then the pandemic
Right,
ended all.
right.
Now we're looking at expected inflation rates. And it's interesting that the expected inflation rate 1 year ahead has risen quite significantly. It was really, as Cathie points out, due to oil and gas prices. The Fed dislikes this trend in consumer expectations. That leads to the Fed doing things that are not really the greatest in the world. The long-term inflation fears hit late 90s level. We're back here. Well, we're really here and here.
Hmm.
And so Clinton-Gingrich era had similar inflation concerns, and falling oil prices may soon lower expectations. It's more than possible. I think the
Yeah.
oil price is going to drop like a lead balloon.
Well, we've already dropped. We're sitting at around 66 right
I
now.
think it's got a way to go down
Yeah,
further.
I think we'll be under 60, maybe even by next week.
But that's a big number. If it gets below under 60, that's a big number, because that number, the last time we saw that number was, really how many years now? It's almost almost 2 decades.
Yeah, and that would be 10% lower than even now. And
Yeah.
gasoline prices have not yet quite followed. They're
No.
there. They're not bad. The gasoline prices are okay, but they haven't followed to the lows. So we might see also gasoline prices dropping pretty nicely over the next 60 days.
And then we go to economic indicators, and firstly, existing home sales. Well, they're at historically low level. That's no surprise to anybody, given, where interest rates have been, given how people are locked into their very low mortgage rates from, the days of 𝐒𝐿𝐴𝐵, zero interest rate. And current levels are much lower than the 5 million plus seen in the late 1970s. Many homeowners trapped by high mortgage rates or the low mortgage rates they already own, and administration focusing on long-term interest rates to address issues. So there's a lot that's got to have happen in order for this to be right. I mean, I'm looking at the value of my own house. It's gone up by 30%, 35%, if you believe Zillow or whatever,
Right. Mhm.
just about 18 months.
Yeah, yeah, yeah.
It's amazing, you know.
Yep. No, it's crazy. It's great. No, again, I've made the comment. I'll say it again. I follow real estate extremely closely and have for 25 years because of specific. I mean, I've written a couple of books on real estate. My own personal projection is that we will see interest rates coming down over the next 3 months. You will see we get into season, which starts about now. And as we get into season, the prices are going to be up. They're not going to be down. They're going to be up. So any idea that the housing market prices are going to stagnate or go down, there is no inventory. They can't go down until we get more inventory.
But
So
Randy, think about the middle class home buyer. Think about the price problems that home buyer faces, because we've had these home prices go up constantly. His or her income have been relatively static.
yep.
And so the affordability, even at 4% interest rate, is not going to be great.
Yeah, but what you have is you see the middle class has been out of the housing market for 15 years because they haven't been able
Right.
to afford it. It's the professional class. My son, probably your kids, other people's kids that I know, they're buying homes because they're making six figures, uh,
Yes.
and they're able to afford a 400 or $500,000 home in Carolina or in Texas. They can't afford California unless they get out in the desert, like me. And even Riverside is way more expensive than Carolina. But if you go even further out into the desert, you can find the $400,000 home.
So um, we go to US net income, non-corporate divided by corporate. Well, this is the big versus the small.
Yes.
Here, so non-corporate divided by corporate. So this is, the small guy versus the big guy.
Yep.
Look at this ratio. I mean, we've never seen this. We haven't seen this since well, it says 1960, but you'd have to go back to 1940s to see this, you know. I mean, this is incredibly low. They say small businesses have struggled since COVID. Yep, I think that's about right.
Yeah.
And they're due for recovery via deregulation and tax cuts. Couldn't have come sooner.
Right.
Mid-90s tech boom aided small firms after commodity spikes. Similar productivity surge is expected soon. Could not come sooner. Small businesses are the key to job creation. I mean, the whole of job creation has been government,
Yeah. Yeah.
both federal and state and local.
And
And
the ancillary, the advisors and the people that make their money largely off
yeah,
government
I include them all. So,
and
all the advisors.
healthcare and education. Yep.
Yeah. I don't know that even healthcare and education are relatively marginal. Well, no,
Oh,
healthcare is not, government is.
if you put all those together, Larry, the state, federal, city, et cetera, healthcare, education, and the people that make their money 90% off of government, that's been almost the entire increase last year.
I agree with that. I've seen those numbers. So now we're looking at the yield curve, 10-year Treasury minus the 2-year Treasury. This is your favorite
Right.
beat. And we see it's finally rising out of the dismal less than zero. Cathie makes the point, and we make it every month. This is this grayed out bar is the recession. Every time this sucker dips, where the long-term yield, the long-term interest rate, or the interest rate on long-term bonds are less than the yield, the interest rate on a 2-year bond. And every time it's dipped in the past, traditionally, when it actually reverts back to a positive state, we get a recession. And Cathie makes the point that they haven't called for the recession, and there was actually a recession in this period here that they declined to call for. But she makes the point that we're in what she calls a rolling recession of a certain proportion or a certain section of the economy, which agrees with everything we've been saying now about the small business, the wage earner. They've been in the recession all this time.
So manufacturing, housing, small business, all the related housing, things like Home Depot, the kinds of things like small hardware stores, et cetera, that would make money from people moving, et cetera. These businesses have been in transportation, in other words, haulage, all of that has been in recession now for 3 years. And she makes the point also that that's what needs to recover.
Yeah. And so, whether they'll actually declare a recession or backdate a recession, I think it's become a political football now, unfortunately. A positive curve isn't yet convincing for recovery, and economic research may later confirm recession finding. And that's happened in the past, that they've discovered a recession when they look back and there's no political cost for them declaring a recession. It's become a political football.
And Larry, as much as we look at this yield curve situation, what we're doing right now, though, is a complete reset. What Trump is doing is what Clinton did, what Reagan did. This is a reset. So if we had the yield curve in a perfect situation, if you do this reset, this is what I've been saying for over a month now, ever since Trump took over, if you cut the federal government by as much as they're talking about cutting the federal government, and then you've got the knock-on effects of doing that, you almost can't avoid a recession. You almost have to have one. Now, is it a full 60 day? I mean, a full 6 months? Or is it only 4 months or 3 months? But you're going to have a period of time when it seems like you're taking so much out of the economy that how fast can you put it back? And this was what I want to say it was the all-in guys were talking about last night.
Yep.
Is that it might be, to your point, Larry, 3 weeks ago when we were talking about this, it might be that those people that leave the federal government get into productive positions in manufacturing, in transportation, in housing. Maybe they get into those positions fast enough with the kind of new energy, new enthusiasm to get the economy going before the impact hits of the federal cuts.
Well, that's classic Randy Kirk optimism. Randy always takes this very optimistic view. I have a different view. I think that people who become attuned to working in the federal government, whether directly working in the federal government or consulting to the federal government, are going to find adjustment into the real world extremely hard. People who are working in education, quote unquote education, not teaching kids, but administering, quote unquote, education, they're going to find it extremely difficult to find a job. Not because there won't be jobs available, but because they are not used to working in jobs.
Yeah,
This is a very serious generational problem.
no.
We have a generation of people who are overeducated in non-productive pursuits. Now, I am, all for the arts. My wife is an artist, very productive artist, and she's done extremely well in the field. So I'm not decrying artists or their productivity. I'm decrying the academic education of the last 2 decades.
At least.
Because it has headed us in a direction where we have these, and I'm going to call it by what it is, leeches on the economy. They are going to find getting back into work extremely difficult. And you see it right now. People refuse to return to the office. Why? Why would you refuse to return? Yes, it's very nice working from home, but it's even nicer not working from home.
Right, right.
So if they were working at home, that would be one thing. But the reality is, you and I know it, and most people do know it. I know I'm going to get a lot of hate mail for this, but people do not work when they work from home. Now, I ran a company that was virtual. We had offices in India, in Israel, and all over the United States. And all over the United States meant people were working from home. We had a few hotspots where people could gather, and we rented them offices so that they could gather. But essentially, they were working from home. And they were very productive. But that is a whole lot different from working for the government or working in education and working from home. Because working for the government has become an oxymoron. And working in education, not teaching, but working in education has become an oxymoron because they have invented so many positions of unproductive type of work. In fact, negative production. Most of the time working from government means imposing work upon the productive elements of the economy. Now, these are tough words. A lot of people are going to find them very offensive, but it's just the reality as I see it.
There is a fraction. I don't know what the fraction is, but I've run into them, for many, many years. Well, my whole life, of course, I've been working primarily with bicycle retailers, but then the last 16 years, I had about 400 clients that were in small businesses from plastic surgeon to chimney sweep. I mean, every kind of small business you can think of. You would be amazed how many of those small businesses are people that did their 20 in government and then opened up a small business. So there is a certain percentage of government employees who in the back of their mind think, boy, I think I would really love to own a business. And they commonly end up doing it after they get their pension.
But culturally things have changed.
That's true.
Culturally things have changed. I remember the days when the government service, with the civil service, was incredibly productive and very excited to be productive. Those days,
it's a different story.
I know we always look back at the good old days, but that was the good old days. Anyway, what can I say? It is just a reality. The level of graft, they call it grift today, but the level of grift, we see it. We've seen it now in all that's been exposed by Doge. It just didn't exist 20 years ago. I'm sorry, it did not exist.
Right.
And when I came to this country in 1963, it certainly didn't exist.
True.
And today it does exist in a very large measure in many of these departments, not the least of which in the Department of Education. And the well, let me get off my high horse. This slide is, a technical slide again, the 10-year Treasury versus short-term government yield. We've been over this conversation at length, and the question of the positive yield of the 10 years versus the short term. But Cathie introduces a new concept this month, because she takes this back before the 30s, or before the 40s, actually. And if you go back to before the 40s, look at this interesting factor.
Oh, yeah.
Hadn't seen this, had we?
No, we had not.
And we haven't discussed this, but these positive yield curves really followed the Reagan era. In the late 1800s to early 1900s, we had frequent inverted curves. Now, I do know we had frequent recessions, we had frequent depressions almost, but the gold standard and innovation kept long-term yields very low. So it was normal
to have these yields.
to have these inverted yield curves. It was normal to have long-term yields lower than short-term yields. Think about that.
Yeah.
And, I can almost remember those days, because when I grew up, we were kind of in this era here, and it was really somewhat different. Yeah. So Bitcoin may mimic a rules-based monetary system. So Cathie ascribes this to a rules-based monetary system. These were, years in which the pound was sovereign, gold was king, and tech booms could repeat historical. So here again is the innovation, the law of innovation as defined by Cathie. And here's a new corollary to that law, that when you have a highly innovative economy, such as we had in this incredible second industrial revolution, or actually third industrial revolution, it's accompanied by very low long-term interest rates. We're going to test that shortly.
Yes, it will be interesting to see what happens.
Yeah, it will be interesting. But this is the first introduction of that slide, and I thought it was an incredible slide because it opened my eyes, and I think it opened yours as well.
It did.
And this is a populous. This is Cathie's slide. She loves this slide. What the slide shows is that commodity prices have not really changed at all.
Right.
Since the late 80s, late 90s, and the 2000s. She says that dollar strength inhibits or limits commodity gains. Tariffs may influence future price trends. So tariffs may, now I guess she means they're going to actually depress commodity prices.
I think, Larry, that this might be something that we can almost count on in the future. That doesn't mean there won't be spikes, but I think the extraction costs are going to continue to go down, and that's a big reason why we're seeing this, is because extraction costs have gone down. I think we're going to find that the science in terms of how we find these.
Can I challenge your thought that extraction costs go down? Extraction costs should go up.
Why?
Because as a commodity gets rarer and rarer, in other words, as we win the easily got commodity, and we have to drill further and further and further, say for oil, or we have to dig further and further, say for coal, or we have to dig further and further for gold, it becomes more and more expensive to actually extract it, even though our our methods get more and more refined.
Yeah, so I think you're right, but that was going to be my second point, is I think we're going to find that the science of finding the deposits is going to dramatically improve. There was again on All In podcast last night, they were talking about a company right now that is using AI to figure out where rare earths are located, very successfully. And it may turn out that we have, you know, they may turn out to not be rare. They may just turn out to be earth instead of rare earth. So as we get better and better at locating uh,
And refining.
and refining,
Yeah.
or extracting and refining, we may find that the commodity index continues to be something that is flat.
Now, when I say refining, I mean all commodities.
Yes, right.
So, for example, we are really learning to recover all of the commodities, all of the metals used in, say, batteries, and recover like 90% of them or 95% of them.
Right.
I mean, it has been posited. So Red would say that we will reach a stage where we will no longer ever have to mine
Fine. Yes.
lithium or any of the rarer commodities that are found in in EVs.
Yes. Yes.
All right. So in other words, you actually see a decline in this commodity index.
I think flat would be fine.
That would be
It,
good.
it might go down, but I think it's flat. Yeah, flat.
The US dollar index, so it's dropped nearly 5%, but has remained strong since 1990. Actually, I think it's remained strong since 1890. Tariff sparked fears of economic slowdown. Historical range suggests resilience. Dollar's purchasing power may rise with tariffs, thinks Cathie. Global currency moves affect its trajectory. And I am so bad at forecasting currency movements that I just defer to Cathie. I don't know how you feel.
So, listening to Secretary Scott Bessent of the Treasury, he was asked very specifically, is the Trump administration giving up on its normal uh, dollar, uh, its preference that the dollar be strong? And Bessent said, I'm not going to try to outthink the president on this. I'm not going to get ahead of him on this, but he says, in no way is it the opposite. So the reality is that yes, all the things that are happening right now could impact the dollar, especially as the interest rates go down. They go down faster than other countries' interest rates goes down, then it's very likely that the dollar would drop in value. But Bessent feels that the Trump administration is not trying to push the dollar down, and that a strong dollar is still going to be a part of the attitude of the Trump administration.
Yeah, you'd think that if they can get a hold of this problem of the deficit, that would strengthen the dollar ipso facto. I mean, it seems that that would follow.
Well, productivity will do that. So that was actually, you got it exactly right, Larry, because he went on to say, if the economy is strong, ipso facto, the dollar will be strong.
Exactly, exactly. So there's some offsetting issues relating to that, but definitely if inflation drops, if the economy improves, that would follow. So that would appear to be the government's policy and the Trump policy. But the dollar is quite complicated. The relationship of the dollar to other currencies is quite complicated. And I know many, many people have lost a lot of money trying to forecast the value of the dollar.
Exactly.
And then we get into this very interesting chart that Cathie runs every month where she tracks the metals to gold ratio. And you see this tremendous disparity between, the 10-year Treasury yield and the metals to gold ratio, which means, the basket of metal prices versus the gold price. Well, the gold price has gone up, therefore that ratio has gone down very dramatically at the same time as we've seen the Treasury yield go up. Now we expect that Treasury yield to come down because we believe the interest rate will crack now. Interest rates haven't fallen, or Cathie believes that, or she's beginning to believe the interest rate will crack now. Interest rates haven't fallen as in the past downturns. The rate drop could boost housing and recovery. Tax cuts and deregulation could spark a boom, and animal spirits will drive. So, you know,
She left out one, Larry. She left out that the Chinese, the Japanese have been buying gold and selling bonds, selling our treasuries. They were thinking about this BRICS thing. Everybody's talking about this, getting away from the gold standard. And so they were selling off the bonds and buying up lots of gold. According to Putin, he's not at all interested in the dollar not being the reserve currency. And so all of a sudden, I think this is going to contract, but I don't know if it's going to contract a lot because gold right now just has a lot of interest from foreign governments as well as from the consumers.
Do we both agree that gold is going to exceed $2,000 in the short term?
3,000.
I mean, 3,000. Can we both agree that we're going to
It's so
exceed
hard.
3,000?
It's hard to stay. It's hard to stay in the right ranges, Larry, because they've all changed so much.
Changed, yeah. We're so used to gold being 2,000.
I do think it will go over 3,000. I'm just wondering whether at some point it is out over its skis, though. There could be a point at which it will
Well,
say,
if the BRICS story holds, if the Chinese-Russian story holds, then it will definitely, and particularly if the United States is starting to focus on Bitcoin as a reserve currency, it could be that the world splits between the sort of gold standard and the Bitcoin standard, as crazy as that may sound right now. So that's more than a possibility. We haven't discussed the whole Bitcoin standard anymore.
yeah,
What's going on with Bitcoin, but it's very.
go.
So now we're looking at the yield spread, the US corporate high yield spread over 10-year Treasury. So why is that important? It's important because high yield, is low quality 10-year, low quality corporates, US corporates. That is to say, the ones that have the highest yield, they're the lowest quality, and how they're spread versus the US Treasury yield. And that's an indication of credit market distress. When you see that yield, when you see corporates that have not the stellar credit, you see them having to borrow at 10, 12, 14%, as you saw, say, before 2008, you realize that we're in trouble. There's a credit market distress. Well, that's not happening. We're running at, historically normal levels, quote unquote, normal levels. So the focus on large firms, not struggling small firms. Struggling small firms are still in trouble, but that's not an indicator of interest rate yield issues. It's a different issue entirely, as we've discussed at length. Markets see little risk. Small business pain isn't reflected here. Spread stability supports optimism. So yeah, we can all, party as if there's no end to the.
Okay, so every month the Small Business Federation, their numbers come out again this week. The small businesses don't need money. They are hurting. Their sales aren't what they want. Their profits aren't what they want. But they're fine. Their balance sheets are fine. Medium-sized business, Russell 2000. Their balance sheets are fine. They just don't need money. They're mature businesses, and the entrepreneurial spirit might be starting to show up in the young people now, but it hasn't up until now. And so you've got very mature people running very mature businesses, and they just don't need the cash.
I'll correct you a little. The mid caps don't need cash, but I think the small businesses are struggling.
That's not what it's two. I think it was 2 to 3% of the small businesses, month after month after month, say they can't find the money that they need to run their business. It's a very small percent.
Well, that's not my impression, but if that's what the numbers show, that's interesting. Then they're in less bad position than I placed them in.
Well, I've talked about this before. A lot of small businesses today, Larry, that I'm talking to, the ones that I've been working with, the spouse works, the medical bills are the medical insurance comes from the spouse. The small business that the other spouse is running is able to manage,
Hmm.
even if the numbers aren't as good as they need because their kids are grown, they're out of university, they just don't need they don't need to, and they're not trying to grow. They're not at that stage of their life. They're not growing.
So that's interesting, but you're speaking to mature people. You're speaking to people who are past their middle age.
Uh-huh.
And they've been in business for a long time. I think it's the younger people who try to start a business and they get into really serious financial difficulties.
I
I'd be
think,
interested to see the demographics on that.
yep.
And then finally, we get to, yeah, we're in this turning point. The economy is balanced or imbalanced on this kind of, this, what is the thing called? That seesaw,
Seesaw, teeter-totter.
teeter-totter, you call it here. We called it a seesaw where I grew up. Um, and Cathie thinks that the big difference is we're in a new age of innovation. We're in the fifth, industrial revolution. This new industrial, third or fourth or fifth. I
don't
keep
know.
getting.
Try to keep track.
Yeah. So she looks at global GDP growth, and this slide is a little difficult to read, and I probably need to blow it up a lot larger. Cathie says that real GDP growth could hit 7.3%. This is US real GDP growth.
Yeah.
No, global, 7.3% up from 3%. That would be stunning, wouldn't it?
Yeah. Yeah. It's all about AI and robotics.
Pre-1900s, the growth was before the first industrial revolution, growth was 0.6%. And tech leaps boosted it. So Big Ideas 2025 details this tech-driven jump. So big ideas are, Cathie has defined these major sources of innovation, and they're thematic, and thematically they all align together. And she thinks it's going to create this entirely new age, just as, the turn of the century, the 19th century created a new age with the invention of, flight, the invention of electricity, invention of,
Oh,
radio. And so all of these incredible inventions powered the 20th century. And she thinks that this new innovation phase are going to power the 21st century. So Big Ideas 2025. And it's worth downloading that Big Ideas and reading it. It makes incredible reading. You realize what is the thesis behind 𝐒𝐻's investments. And you realize that, yeah, what you have to do is buy 𝐒𝐻 funds on a, and this is not investment advice, but this is how I do it. Buy 𝐒𝐻 funds on a monthly, quarterly, annual basis over time, because there's going to be this gigantic rise as they, mature into their futures. And she says that 14 to 15 technologies may exceed past gains. And these technologies are defined into, these five principal pillars of growth. And the 7.3 estimate may be conservative. And so certainly if it's a global estimate, you can expect the US growth to exceed that by far. And then she looks at the slide. It's very interesting. These are log years, but she starts at 100,000 BC and gets to 1 BC. And in all this time, the human race grew at a rate of 0.37%. How they measured that, I don't
I
know.
don't.
And then from the year 1 to 1500, we grew at 0.14%. And then from 1500 to, what? No, this is 1,000 to 1,500. We grew at 0.3%, just plodding along, as it were.
Yes.
And of course, we faced some terrible, terrible, pandemics during that period of time. Now we know just how badly pandemics distort. And then even up to 1900s, we grew, 0.8%. But in the late 19th century, before we got to 1900, the first industrial revolution started up. And what resulted from that was a 3% growth across the board. And so ARC is forecasting a jump in growth to 7.3% in this new AI world that we're entering into. Of course, IMF simply take the past and project the future from the past, and they're saying 3.1%, and we're saying 7.3%. I think there's some risks to the 7.3%. There are some risks, but time will tell. But if they're right, it's going to be very, very good for the economy, and particularly for the US economy.
Yeah, and of course, the number one place that we're already seeing this opportunity, and I think the first place that we'll really feel it is going to be energy, but then right behind energy is going to be robotics. And we, of course, in the world that most of the listeners are in right now, Tesla is at the forefront of the energy, the robotic car, and the robotic humanoid. And those three alone are going to create massive, massive productivity gains.
Right. And I think a lot of the productivity gains also come from AI, where Tesla's in the midst of that as well. And that really, they're using AI to power the robotics and the full self-driving, the autonomous car. So, that's really the thesis, and she's looking at these growth rates now in the small, like just in the year by year, to 14, 2020, 19, 2024 to 2030 estimates. The Mag 6 tripled in value, she said. Disruptive innovation grew at 30%. And market broadening will favor neglected stocks. And she's in really essentially the neglected stocks. Post-intellectual breakout in innovation indexes occurred, broader indexes struggle to recover, and a historic bull market may emerge. It's hard to imagine a bull market emerging out of what has been a bull market.
Yes.
But there you are. I mean, so it's worth studying this slide. I'm not going to go into it in great detail, but it's very much worthwhile studying the slide, where she shows the difference in what she calls the non-disruptive, the Mag 6, and the disruptive businesses or innovative segments. And she's talking about some explosive growth, incredibly explosive growth. So we may see a repeat of the stock market in terms of the concentration into these super innovations. But I will say one thing. I think a lot of innovation is now taking place in the private markets, not in the public markets.
Yes.
It's interesting that Tesla is one of the few public companies that the public can buy.
Yes.
In an extremely innovative space in what has now become essentially the private markets. So you get in the private markets, these gigantically innovative companies, but they remain private because the public markets do not understand them. And you see this in the analysis that takes place. You and I have discussed this. The analysis that takes place about Tesla is all about the current earnings and all about the current products. There's no value ascribed at all to the innovations coming shortly that we know about. These are the things that the private markets spend a lot of time in trying to derive value of, because it is in these areas that the private markets have done so well. And they don't play well in the public markets. I mean, you only have to see the analysis of the Wall Street analysts to see that they don't get any value at all. Our own, Gary Black will not ascribe any value to them. So that gives you a sense of, where Tesla is in this playground. But I strongly recommend everybody listen to Cathie, the real Cathie, not us two, would-be pundits, because I think there's a lot of wisdom in those words.
Yes. All right. Yes. And I would just add to what you just said that even our own community, this morning, Brian Wang and I put up a video, the first of a series of videos that we're going to be doing on Optimus, and it had very disappointing numbers. The video that we did just last night on another subject that was more current, more right now, it did extremely well. So it wasn't Brian's fault or my fault. It's the same two personalities. But this morning, the headline was all about Optimus, and it's getting only so-so numbers. So Optimus is still out there. It's not well understood. People still think of it as something to do your ironing and your dishes. And so people are not using the opportunity that is there for the information arbitrage, with regard to Optimus, the way that they did the information arbitrage with regard to the vehicles.
Right. And now there are some slides that Cathie has done to illustrate the growth of AI and where the AI grows. And I think that we've gone on long enough. And that conversation is really about a segment of this innovation that is very important. And so I encourage people to go and look at it and look at those numbers. It's some very interesting information, particularly about Grok and also about the dominance that OpenAI has in the market right now. And I leave that as a teaser just to incent people to go and look at the In the Know on YouTube. Because I think we've covered this and bored people enough. And if people are still with us, congratulations.
Thank you. Staying with us all this time. All right, Larry, again, happy birthday to you, and
Thank you.
many happy returns and many, 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 many more years of productive life. And to all of you out there, it has been phenomenal, amazing, and incredible talking to you.